something unusual is happening in the silver market, and almost nobody is talking about it. While headlines remain focused on stocks, interest rates, and short-term volatility, silver is quietly positioning itself for a move that could catch the majority of investors completely off guard. This isn't hype. This isn't speculation. This is the kind of silent setup that historically appears right before major market shifts. Silver has always been different from gold. It's not just a store of value. It's an industrial metal, a monetary asset, and a strategic resource all at once. And right now, all three forces are starting to align in a way we haven't seen in years. Beneath the surface, pressure is building. Supply is tightening. Demand is accelerating. And the disconnect between silver's real-world value and its market price is becoming impossible to ignore. What makes this moment especially important is timing. In past cycles, silver doesn't move gradually. It moves suddenly. Long periods of silence are often followed by sharp, aggressive breakouts that leave late investors scrambling. And right now, we are seeing many of the same signals that appeared before previous major silver rallies. Institutional positioning is shifting. Physical supply is becoming harder to source. And industrial demand is quietly climbing as global energy and technology sectors expand. Yet most people remain focused elsewhere, unaware of what's building beneath the surface. This disconnect is where opportunity lives. What separates smart money from emotional money is patience. Smart money doesn't chase headlines. It studies structure. It watches what the market does when nobody is paying attention. And right now, silver is behaving in a way that suggests accumulation, not distribution. When assets stop falling on bad news and start holding their ground, it often signals strength forming beneath the surface. This is exactly the type of environment where major moves are born, quietly, slowly, and then suddenly. This video is not about hype or prediction. It's about understanding the setup before the crowd arrives. Because once silver begins to move, it rarely gives second chances. By the time the headlines turn bullish, the real opportunity is already gone. What matters now is recognizing the early signals. And that's exactly what we're about to break down. To understand why silver is quietly positioning itself for a major move, we need to look beneath surface level, price action, and into the deeper mechanics of supply, demand, and global pressure. Unlike gold, silver carries a unique dual role. It is both a monetary metal and an industrial necessity. This dual nature is what makes silver especially powerful during periods of economic transition. While investors often focus on inflation data and interest rates, industries around the world are consuming silver at accelerating rates. From solar energy and electric vehicles to advanced electronics and medical technologies, silver is becoming more essential with every passing year. Yet, unlike digital assets or fiat currencies, silver cannot be printed or expanded overnight. Its supply is limited, mining production is slowing, and new discoveries are becoming increasingly rare. At the same time, above-ground silver inventories are quietly shrinking. Large industrial users are securing long-term supply contracts, and governments are increasingly aware of strategic material shortages. This creates a structural imbalance. Demand continues to rise, while supply struggles to keep pace. Historically, this type of imbalance doesn't correct itself slowly. It builds pressure quietly, then releases it suddenly. That's when price moves accelerate, and market narratives change overnight. What makes this phase especially critical is that much of the public remains unaware of how tight the silver market has become. Prices can remain suppressed temporarily through paper markets, but physical realities always reassert themselves eventually. Meanwhile, global economic uncertainty continues to rise. Inflation may fluctuate, but purchasing power steadily erodes. Central banks attempt to maintain control, yet debt levels expand faster than growth. In this environment, tangible assets begin to attract attention again, not because of speculation, but because of necessity. Silver sits at the intersection of protection and utility, making it uniquely positioned for what lies ahead. When industrial demand collides with monetary hedging, pressure builds from both sides. This convergence is not common, and when it occurs, the effects can be dramatic. What we are witnessing now is the quiet stage before recognition. The smart money isn't chasing headlines or waiting for confirmation from mainstream media. It is positioning early, understanding that markets reward foresight, not reaction. Silver's behavior today reflects accumulation, not exhaustion. And when awareness finally catches up, the move may already be well underway. This is the phase where patience matters, because once momentum takes over, there are rarely second chances. One of the most important truths in financial markets is that the biggest moves rarely begin in public view. By the time headlines start shouting about opportunity, the real positioning has already taken place. Smart money operates quietly, patiently, and with intention. It doesn't chase trends, it creates them. Right now, beneath the surface of daily market noise, institutional behavior is revealing a shift that most retail investors have yet to notice. Large funds, central banks, and long-term asset managers are adjusting exposure in ways that suggest preparation, not speculation. These entities do not act on emotion. They operate on data, probability, and historical cycles. And when their behavior begins to align across regions and asset classes, it sends a powerful signal. Silver's recent behavior reflects this quiet accumulation phase. Price movements may appear modest on the surface, but underneath, volume patterns and physical demand tell a different story. When large players accumulate, they do so carefully, avoiding sudden price spikes that attract attention. This is why accumulation phases often look boring, until they're not. History shows that once this silent phase ends, momentum accelerates quickly, leaving little time for late participants to react. The early stage is where risk is lowest and opportunity is greatest. Yet it's also where conviction is hardest to maintain. Another critical factor is the growing divergence between paper, markets, and physical reality. Paper contracts can suppress price signals temporarily, but they cannot create physical supply. When industrial demand meets investment demand, pressure builds beneath the surface. At that point, pricing mechanisms begin to strain, and the market is forced to reconcile perception with reality. This tension is not visible on daily charts, but it becomes clear when viewed through a longer lens. Smart money understands this dynamic and positions accordingly. What separates experienced investors from emotional ones is not prediction, it's patience. The ability to remain steady while others grow impatient is what defines successful positioning. Silver's current behavior reflects this exact moment in the cycle. Not explosive yet, not chaotic, but quietly coiling. The silence before movement is often louder than the move itself. And those paying attention now may find themselves positioned long before the broader market realizes what has already begun. Beyond market mechanics and institutional behavior, there is a much larger force shaping what comes next: the global economic environment itself. We are entering a phase where traditional financial tools are becoming less effective. Interest rates can only rise so far before they begin to break growth. Yet lowering them risks reigniting inflation. Governments are caught between controlling prices and sustaining economic activity. And that tension is growing harder to manage. As debt levels continue to climb across major economies, confidence in long-term monetary stability weakens. This is not a sudden collapse, but a gradual erosion, one that often goes unnoticed until its effects become unavoidable. At the same time, global supply chains remain fragile. Geopolitical tensions, shifting trade alliances, and increasing energy costs are reshaping how countries secure essential resources. In this environment, strategic materials take on new importance. Silver, unlike many financial assets, sits at the intersection of industry, technology, and monetary value. It plays a critical role in renewable energy, electronics, and infrastructure, sectors that governments actively depend on to fuel future growth. This creates a unique pressure point where demand is policy-driven, not speculative. What makes this moment especially significant is that these pressures are converging simultaneously. Monetary uncertainty, industrial demand, and geopolitical realignment are no longer isolated forces. They are reinforcing one another. When multiple systems strain at once, markets tend to reprice quickly and decisively. History shows that during such transitions, assets tied to real-world utility and scarcity tend to outperform those built purely on confidence. Another key factor is trust. Financial systems function on trust in currencies, institutions, and promises of stability. When that trust begins to erode, even subtly, capital starts seeking alternatives that exist outside political influence. Silver's role in this shift is often underestimated, yet it has repeatedly proven its relevance during times of systemic change. It does not rely on policy decisions or central bank credibility. Its value is rooted in physical reality. What makes this moment truly significant is not just what the data shows, but what history teaches. Every major financial shift follows a familiar pattern: disbelief, quiet accumulation, rising tension, and then sudden realization. Most people only become aware once the move is already underway, when prices are no longer calm and decisions feel rushed. But those who understand cycles know that the most important phase always comes before the headlines, before the urgency, before the crowd. That is where we are now. Silver is not screaming for attention yet, but it is speaking clearly to those who know how to listen. This is not about predicting an exact price or timing a perfect entry. It's about recognizing that structural pressures are aligning in ways that rarely happen together. Industrial demand is growing, supply is tightening, monetary systems are strained, and confidence is slowly shifting. These forces don't reverse overnight. They build quietly until momentum becomes undeniable. When that moment arrives, silver doesn't move gently, it moves decisively. And by then, the opportunity to prepare has often passed. What separates informed observers from reactive participants is awareness. The ability to step back, see the broader picture, and understand how history rhymes rather than repeats. Markets reward patience, not panic. They reward those who position themselves before narratives change, not those who chase momentum after it's already visible. Silver's current behavior suggests it is in that early phase, where conviction is tested and clarity is rare. That's precisely why this moment matters. This channel exists to provide that clarity, not hype, not fear, but perspective, to help you see what's forming beneath the surface, before it becomes obvious to everyone else. Whether you choose to act now or simply observe, understanding the forces at play gives you an advantage most never have. Because when the shift finally becomes visible to the world, it will feel sudden, even though it was years in the making. The question is not whether change is coming. The question is whether you'll recognize it before the rest of the world does.